work at QiDao. It's a stablecoin. Been running for a few years. And here we'll do a little quick intro of everybody, very brief. Not too much shilling, but go ahead.
Hi everyone, I'm Benjamin. I'm the founder of CAP. We're a stablecoin on top of EigenLayer, and we're also a flagship stablecoin for Mega ETH.
Hi everyone, Mike Silagadze. I'm founder and CEO of EtherFi, and we're building a DeFi bank. So basically a full end-to-end alternative to traditional banking, but built on chain, fully self-custodial.
Hi everyone, Amir. I'm the CEO and founder of Puffer Labs. We're building all you need to get on chain. Of course, started as permissionless LRT. Now we expanded to actually providing the infrastructure for very fast execution environments, aka rollups as well.
Hi, I'm Daniel. I'm a SaaS smart contract engineer at Uniswap, and I'm working on V4, Unichain, basically everything that is smart contract related.
Hi everyone, I'm Marwan. I lead the DeFi team at BNB, which is the layer one that spun out of Binance, so focusing on investments and incubating new protocols there.
Awesome. So we got a little bit of everything. Uniswap, BNB. We can tap into that energy soon. But first, I want to get started with EtherFi and Puffer. So in general, Aave continues to dominate and be the go-to venue for leveraged borrowing, particularly for most LRTs. So you gotta be friends with them. But it's sudden exit from Polygon and also engaging in governance has been kind of interesting for monopolistic concerns around misalignment, especially long term. Mike and Amir, how are you thinking about having such a dependency on a large protocol like that?
So I mean, we're obviously EtherFi is a very close partner with Aave. We have, I think, something like $4 billion in assets on Aave. It's very widely used. I mean, it's definitely, I don't know that I necessarily worry about dependence on Aave because, I mean, it's as close as you can get to a blue chip protocol. But things that we worry about, for example, is just the amount of our staked assets that are specifically in one or a handful of strategies.
So concentrated risk in a single venue.
Less so single. So single venue would be less of a problem if it wasn't just one very dominant strategy, which is mostly ETH looping. So that actually is a bigger concern, which is why we've actually been focusing more on encouraging different DeFi strategies than just that one, because it's very sensitive to interest rates, like cost of borrowing ETH and staking yields. So if those ever kind of go upside down, that could lead to a very rapid kind of unwind.
So in terms of those strategies, percentage-wise, are you thinking 60-40 would be ideal, or where is it at today?
I mean, ideally, there's 20 strategies, and all of them represent 5%. But having one strategy on Aave specifically, one strategy represent 95%. That's pretty scary.
Yeah.
So for Puffer, we're not yet on Aave, even though we're on basically everything else lending. We're not yet on Aave. We passed a proposal to get added to it soon. Regarding this is such a spicy question you were asking here. I know Aave is such a dominant position in terms of the lending market. About having worries about the governance, I'm not so worried on the side of there would be a black swan event of all governance attack where you're gonna hijack the contracts and bad things are gonna happen. But of course, in terms of allowing other protocols to come in, it's a different story. I do believe governances always have this thing of personal opinions being mixed with rational and logical sort of things, personal relationships or personal alignments. At the end of the day, the DAO and the community and governance has to decide what is the best course of action for their protocol. So if there are certain decisions that were made to move in a certain direction, then it should be acceptable because the DAO governance and the decentralized community is making those decisions. So everybody else has to accept I know there has been worries about like the way that the Polygon scenario has been handled. In that scenario, it just did not align with what the majority of the Aave DAO voters aligned with, so it is acceptable. For us, in terms of like risk or like dependency, especially on the growth side, yes, there might be some growth side dependency concerns because Aave is such an established blue chip lending protocol that it hosts almost the ETH or the lending basically supply. So it is important for us to also establish a good communications and relationships with the Aave DAO to get aligned, to get on top of that protocol. I would like to see in the future more trust being established on other lending platforms as well. Of course, lending is such a tricky situation, and I haven't seen any lending protocol that hasn't been like exploited to some level. Even we remember like Aave old days, right? So it's gonna take some time, but eventually, I do believe that this market is gonna have like more participants. In the market.
What other strategies would you add on aside from, say, leverage ETH to staked ETH positions?
Mm-hmm. I mean, like the other like currently. This is the the most reasonable like strategy to sort of like either loop or either have this because it brings you two things, not only the extra yield, but also it gives you an extra farming opportunity. That's why we have seen like much better growth compared to like SDETH because it is actually backed by the protocol's emissions itself. And yeah, it is the dominant strategy. But I do hope in the future, with the expanse of restaking and more infrastructure, we do see that we go away a little bit from the leverage only to actually like deploying our more strategy that has less risky yield.
Yeah, so I mean, the other big strategy is borrowing stables. Like that tends to be people that do that deposit ETH and borrow stables, they tend to be very long-term depositors because they're bullish on ETH or BTC or whatever, and they want to be long forever, and so maybe they'll deposit $1 million of ETH, borrow a couple $100,000, and then go kind of live their life. So we're trying to advocate for a lot more of that, even just as a counterbalance. But you can do other. I mean, Aave is pretty, not just Aave, but like any lending protocol is pretty general. You could do creative strategies around like ETH BTC pair thesis, right?
So mainly LPs, PT tokens as well, or?
Yeah, I mean that sure. For Athena, for example, they have their PT. I assume everybody knows what I'm talking about here.
Pendle, by the way.
Yeah, they have their PT tokens listed on Aave. We haven't pushed for that for a bunch of different reasons, but that would be an example of another strategy.
Yeah, the stable strategy also tax, right? Like once lending becomes officially recognized by authorities, then it's also a very good strategy to do.
Well, we've all seen protocols balloon in TVL thanks to the point systems, partner incentives, and speculation-driven campaigns, only to watch that capital disappear when rewards dry up. From your vantage point at Uniswap, what's working when it comes to retaining liquidity post-incentives?
So I think that when it comes to liquidity, there is basically liquidity is proportional to volume. So if a pool sees a lot of volume but doesn't have enough liquidity, we see LPs earn a lot of fees, which then draws in more liquidity providers, vice versa. But this also creates like a chicken and egg problem where you cannot have volume before you have liquidity. So that's where a lot of these liquidity mining incentives come from, where they can offer additional yield in order to facilitate more volume. And I think here the most important part is organic growth and real sustainable volume.
How organic? As in retail can come in, or as in fund managers?
No, for me, like speaking of a perspective of a new project that just launched, this could also just be outreach into the crypto community, onboarding new users. But they need to have some liquidity that they can swap against. And what I see most is this naive approach where TVL is targeted as a key metric for liquidity incentives. And I think that's where all of that basically what you mean with or said with drying up liquidity comes from. If you just attract a lot of LPs, but this dilutes kind of the real yield of the liquidity providers because they end up with way less revenue, real revenue, and everything is propped up by that artificial liquidity incentive. What I've seen some projects do is instead of targeting TVL, they target a yield to liquidity providers. So let's say they target a 4% yield per year. They will then kind of pay the difference, and as you see organic use come in, it replaces part of that liquidity incentive moving forward. This also allows you to run these incentive programs longer. And once they run out, you've replaced a substantial part of your revenue for LPs with sustainable real yield. And then you see a lot better liquidity retention than you would see with just, I would say, the primitive form of liquidity incentives.
So to the other protocols who, you might be able to speak more freely, I would say. How would you react to this? And maybe also added, how do you convert the short-term farmers to long-term farmers?
Yeah, I mean, at least for us, TVL really matters. If you're at DEX, it doesn't matter a lot. You just need to service bids on either side and various sizes. For us, we're a stablecoin. We make money on the TVL. The larger the TVL, the more money we make. And so that's great. I think it also has to do with cost of capital, right? Because most of the stablecoins today earn yield two different ways, right? Either some derivative of betting on Bitcoin, right? So leverage against the dollar, or arbitrage, right? Funding rate arbitrage. The other one is T-bills. And so the problem, one of them is very volatile, right? Like most of the time, leverage on these volatile assets is not very high. People are not using them. So then people default to T-bills. Problem with T-bills is that you're not going to get any large capital allocators coming to your cryptocurrency platform just to get 4% APR. They can go to Citibank and get way better deal, right? And so then the question is, okay, how can we generate enough yield? And today, the only answer to that, at least for the dollar, talking from a stablecoin perspective, is incentives. It's farming, it's points, etc. I think what we're seeing, or at least what we're trying to do, is what if we expand the kind of sources of yield that we're using. So, okay, not T-bills, not crypto-related strategies. There's other things, private equity, there's private credit, insurance-linked securities, project finance. So there's a lot of things that you can do that haven't been done. And I think when we start unlocking these values, sources of value, perhaps we can stop depending on the Ponzinomics.
So EtherFi, I think we've done pretty well as far as retaining our TVL over the 2 years or so, including after the points program and the airdrop and everything else. But I think it almost masks a little bit of what happened within the protocol. If you look at our overall TVL graph, it's sort of going up and to the right. But underneath it all, like some of the early adopters of the protocol have moved on. They were, let's call them sort of like seed investors. They deposited capital, they earned a portion of the airdrop, and then they migrated to the next kind of high risk, high reward strategy. But in their stead, we've had others, more larger allocators, come in and deposit. What it really comes down to, in order to, I guess, gracefully make that transition, which is not easy to do, is what you have to have is real utility, right? So for us, what that consisted of is obviously, we had restaking integrated, but in addition to that, we were integrated with hundreds of other protocols. So EtherFi assets just became the natural choice to use because it was plugged into everything else that was out there, and we added this sort of suite of other products, with Liquid and then Cash and the entire kind of DeFi bank suite, which in turn allowed us to differentiate from other more kind of single point solutions that are in DeFi. So,
yeah, specifically on liquidity, I always feel like liquidity is always relative. You need to always keep a certain level of liquidity according to your TVL, regardless of how your TVL came in, right?
How fragmented?
I'm sorry?
How fragmented? Multiple chains, one chain?
I really do like to focus on Ethereum only, but because that's the liquidity hub for every other chain as well. But it depends on your focus of the protocol, but still it's going to be relative. Even if you have like $1,000 worth of your yield-bearing asset or stable asset on Arbitrum or something else, you have to have relative liquidity back in it. Especially when it comes to like asset that you're like leveraging or like providing as leverage on other protocols, like that liquidity is very important, especially on restaking. Unwrapping now takes like over 14 days. Let's say if you run out of your initial like available liquidity. So it's very important to keep a relative high liquidity compared to the TVL that you have. And that has been our focus like ever since the start, to actually like keep a very nice percentage of like TVL versus available liquidity across the map for users to actually be able to utilize this yield-bearing asset in a low risk mode.
So on the next question, we'll move to Uniswap and Binance, but I do want to ask you guys, are ETFs coming to these LRTs? Are we getting new inflows of, call it DeFi money, to replace some of this retail that kind of died down?
Yeah. So we launched Puffer Institutional recently. It's weird how comfortable institutionals think about this pooled staking or restaking, right? They always say, I do want to know where like my assets are sitting, like not being commingled with other assets, as if they're thinking like they're actually getting somebody else's money or the yield generated. It's like probably a general misunderstanding at this level of like regulatory understanding. That's why they preferred to have their assets sitting in an isolated pool. Puffer Institutional is actually, you can think of it as a mini Puffer, but for institutions that would like to only bring their own ETH and stake it or restake it to take advantage of stake it and restaking. We have already onboarded some of, like to be announced, some of the exchanges that are interested to actually take advantage of like these yield strategies. We also give them the flexibility of making that token liquid, and then they can have like sort of like honor that redemptions themselves. So it's becoming completely institutional focused. Would I want to see them going to a decentralized protocol? Of course, absolutely. But at least this is like a step to get them on chain. It's an alternative option. Are ETFs coming? ETFs are coming to staking. Like we already know that like people have already submitted requests to make the stake, the underlying like ETF assets to be staked, like the ETH ETFs to be staked. I do believe like some of the major exchanges like maybe Coinbase and others are going to be taking care of those. For restaking, it's another whole topic. We do know the challenges of like staking initially, like Ethereum slashing, Ethereum non-guaranteed, like withdrawal period is another like big topic of like debate on the like staking ETFs, but they're being solved as we move forward. And I hope the next step after that would be like the restaked assets ETF and others to be coming into.
So I mean, based on our conversations with, so there's two pools of public market capital that are available now. There's ETFs, and then there's this new breed of treasury companies, right? Like SBET and ETH Strategies, and others. I don't think this ETFs are ever going to do liquid staking or DeFi. Just from various conversations we've had, like it's ambitious for them to run a couple of validators and stake 10% of their ETH. Frankly, I think that's for the best, because having a BlackRock ETF own 30% of ETH stake feels pretty scary. So I realistically, I don't think that's a near-term thing. The treasury companies are super degens. They're going to stake. They're going to put their stuff in Aave. They're going to do all this crazy stuff. And I think that's going to actually lead to more of an influx of capital into those public companies, which actually makes them much more interesting than like Bitcoin treasury companies, because you've got MicroStrategy and you've got 17 other Bitcoin treasury companies. What's the difference, right? So MicroStrategies obviously ends up trading at a higher premium, but these ETH treasury companies, and I guess Sol treasury companies, because those are around too, are going to be way more exotic and interesting, and some of them are going to have higher yields and higher risks, and so I'm super bullish on those. I think we're going to see lots of inflows coming from there.
Awesome. So new capital.
Yeah, so on the ETFs and LRTs part, I think it's not out of the realm of question for these ETF providers at least to make LRTs or be involved in the LRT business. We already see flow traders. There are 15 billion assets under management. They're one of the biggest ETF providers in Europe. They're starting an LRT, right? They're starting it on Symbiotic, delegating exclusively to Cap. A little bit of a show, but it's coming, right? If they're willing to do it for one project, maybe they're willing to do it for other projects. So hopefully, the more and more people start adopting not only staking but restaking, which I think is ultimately the only scalable use case for yield on layer 1 tokens. So I think it's very important.
Is this going to be in trading in Europe, on European exchanges?
Yeah, I don't think they're no. So they're not making this tradable. This is with their balance sheet.
Ah, okay. Yeah, so that's makes sense.
So for you guys, centralized exchanges have historically dominated liquidity rails, but now we're seeing them back entire ecosystems. Kraken, Coinbase is the biggest one, but also Binance, although there's always been this thin wall between BNB and Binance, the exchange. How does BNB think about competing or differentiating from this environment? And does Binance have a role to play here, and how?
So just to clarify, differentiating in terms of BNB versus Binance, or BNB and Binance versus all these other CDFI ecosystems that have
The
popped up?
interplay between BNB and Binance as it compares to, say, Coinbase and Base and
Yeah.
Inc. and Kraken.
It's a tricky one, so I don't know how freely I can speak, but I'll give maybe my own personal take. So kind of this whole CDFI narrative that is, I'll just call it the Sex and Dex interplay, that is now becoming a whole new standard, and people recognize the value of that distribution. I think BNB is probably one of the early movers in doing that, but I think probably was got a lot of heat. I think there was a bit of some critique of that. Maybe I remember the FUD of it being more of the centralized chain, and now I think a lot of the big sexes want that want to play that game. I know that wall may be perceived as quite thin between BNB and Binance, but to be honest, it is very much it has been spun out and is an independent ecosystem. And I think in some ways, if you look at Base, right, there are some protocols that are very much heavily picked and backed by the exchange. Binance has provided a lot of support for a lot of protocols on BNB. There's no secret, but I think in many respects, like, we actually want to have a lot more of these sort of independent, very high-profile protocols to be building on BNB and competing with some of these homegrown, incubated protocols as well. So I'll pause there. But
speaking of endorsing protocols, Uniswap's been very protocol first. How do you view the efforts of Aerodrome and Base, where the DEXs are essentially handpicked by the chain's biggest sponsor?
I think that what we've seen over and over again is that competitors to Uniswap were showing up, and they were heavily propped up by also liquidity incentives, and so far none of them were able to stick around long enough to gain significant market share on Uniswap. So I'm not worried enough, because in my experience, the better product ultimately that just gives users the best price and the best, I would say, revenue to LPs will end up winning. So yeah, I'm looking forward to some competition, but we're also always innovating to make sure that we can stay on top of usage for users.
So you think remaining chain agnostic as well as with Unichain, but offering your product everywhere is probably going to be a better option for users?
Definitely, yeah. We want to be there where users are. So Unichain was not built with a strategy in mind to consolidate all volume and liquidity on Unichain, but rather to be a chain optimized, highly optimized for trading and on-chain liquidity. But that doesn't mean that liquidity will cease to exist everywhere else.
Awesome.
Can I just comment on this? I think, as anticipated 5-6 years ago, all sexes are going to disappear and eventually come on chain. And I do see that as a progress of launching BNB chain, launching Base, Why do we have centralized exchanges? Because they're like these Web 2 things that can execute things much faster. They can have like everything on it, like a centralized order book. They can have things including like privacy because it's just their API. They're just running things on their backend. But eventually we're seeing all this infrastructure is evolving. Like we're getting pre-confirmations, base rollups that are like bringing hundreds of thousands of TPS. Now that whole speed argument is out. We're getting privacy on chain. The argument of privacy on chain is out of the window as well. So now like everybody is gonna come and eventually get their own execution environments that can do all these features that these like exchanges do. And I do see this trend of like them slowly moving towards that. And even you can see Uniswap wanting to have their own execution environment as an L2 to eventually be able to power these like up to speed and DeFi actions that like others like or previously wasn't able to do on like a slower chain like Ethereum itself.
What do you see as the hurdle though? What do you see as the hurdle to that happening? Because we've been you know, banking on that thesis, right? That all the centralized exchanges, a lot of that liquidity and user base will come on chain. But and you're right, we've solved for many of those. But what do you see as the roadblock?
The hurdle is like speed and privacy. Like these are the two top things that like you cannot achieve outside of a centralized exchange right now. And like another hurdle is like, of course, like being able to interoperate across the whole map. Like today, you go on an OP stack, you get on the super chain, but you're not interoperable with Ethereum L1 till like an unprecedented amount of time. So you're like kind of limiting yourself. A chain launches BNB chain like an L1, like it is fully trusted interoperability with the other EVM like places. Like I do want to see like a fully interoperable across the map, which like base rollups are like precursor to that, and that's what we're building for. Is you're creating very fast custom environments for each of these exchanges or for anybody to move their assets super fast. You can also add the addition of like privacy on top of this. So you're creating an environment that has speed and privacy. So exchanges are gonna like.
So given these new environments, I'll keep the questions brief because we only have like 2 minutes. DEX listings versus redemption queues. What are the exit paths that work for the current user base that is a little bit finicky? They don't necessarily want to do as many actions as they did around 2020. They are not willing to spend $500 to open up a pool, but maybe they're willing to spend a couple cents on base. Would you rather build redemption queues or DEX listings?
This is for any asset or?
Yeah, your asset. Yeah.
Yeah, I mean for stable coins, I think AMOs, CDPs, any synthetic asset is on the way out. Let's be honest, right? Like we've, as an industry, agreed that reserve-backed stablecoins are the way. If you want to be at peg always, you have to be redeemable. If you are redeemable, there's no reason to have a DEX at all, right? Like you do not. Okay, there's no reason to have a DEX at all for the purpose of keeping your peg, right? You'll still need to have pairs with like LRTs, with blue chip assets like Bitcoin, etc. But you don't really need a lot of liquidity there, and so it becomes very inexpensive to incentivize having a stablecoin that's liquid. Whereas before, in previous markets, you needed 80 or 70% of your stablecoin in a pair with USDC, and that costs you like 30-40% APR.
Well, so with our staking assets, we just made them redeemable, but we still maintain or work to ensure that we have pretty good liquidity on chain. The reason is because to have composability with other DeFi projects, you need liquidity, mainly things like for purposes of liquidations, so that you can use it as collateral, trade it, and so on. So we kind of need to maintain both, and so redemptions are important, but also liquidity.
Yeah, I think like if you want to categorize it, like it's like liquidity first, then fast redemptions, then like slower redemptions. Like you have to prepare for all these three,
so maybe
depending on the risk
buffer or direct emissions to a DEX.
Yeah, so like we do like emissions to the DEX as well. So for providing liquidity, we do see liquidity as like if you want to do really high risk stuff like leveraging and looping, that one is like priority. Like it has to be available with the least amount of like sort of like slippage. Next level becomes your like super fast redemptions that we introduced before, which we just enable a bunch of like ETH non-staked in our wallet. Like it's not really generating any like yield or anything. This is just to go immediately redeem for that asset. Then the third line of defense, of course, if you run out of these first two, is going to be like you go and you have to redeem. So I really rank these up three. And the much higher on-chain liquidity that you have, it's going to give you much flexibility for taking more risk on that asset. Then you can go down the line for immediate liquidity redemption, and then also like longer unwrapping redemption.
Awesome. So I think we are on time, but thank everybody. We got a little bit of input on all things DeFi and non-Ponzinomics. So thank you.